Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have your company again here at AusBiz. Let's check in on what happened overnight. A mixed session with defence stocks surging amid heightened geopolitical risks. On Wall Street, tech stocks led declines on the Nasdaq and S&P 500, while the Dow advanced. Defence-related shares, including Lockheed Martin and Northrop Grumman, rallied. That's after President Trump said the 2027 US military budget should be boosted to $1.5 trillion. Some defence stocks fell in the prior session after the president threatened to block contractors from paying dividends or buying back shares until they increase weapons production. Mega cap tech stocks came under selling pressure, with investors again questioning inflated valuations related to the AI trade, and memory chip makers lost ground after a recent rally. Alphabet gained after the Google parent surpassed Apple in market capitalisation for the first time since 2019, becoming the second most valuable US company. The shares of carmaker Ford accelerated after a broker upgrade, while General Motors is taking a $6 billion charge to unwind some of the EV investments it's made. And the gold and silver miners lost ground but finished in mixed territory there as the annual commodity index rebalancing gets underway. Well, amid increasing US military foreign intervention, President Trump has said the 2027 US military budget should be raised to $1.5 trillion, significantly higher than the $901 billion approved by Congress for 2026. However, any such increase in the budget would require congressional approval. He said the extra spending would be covered by revenues generated by tariffs he's already imposed on nearly every country and many industrial sectors. And he said the US would still be able to reduce its debt. Well, in the latest data, the number of American new jobless applications rose moderately last week, though demand for labour remained sluggish. December's employment report due to be released tonight, with non-farm payrolls seen as increasing by 60,000 jobs last month. That's according to a Reuters survey of economists, with the unemployment rate estimated to have slipped to 4.5%. US Treasury yields rose ahead of that jobs report. The yield on the 2-year was up to 3.49%, the 10-year up more than 4 basis points to 4.18. And the US dollar gained against the euro and the Swiss franc. The Aussie has slipped back to 67 US cents. On the commodities front, oil prices have rebounded after 2 straight sessions of declines, settling at a 2-week high as investors assess developments in Venezuela amid concerns about supplies from Russia, Iraq and Iran. Brent futures rising 3.5% to $62 a barrel. The spot gold price up around 0.5%, sitting at close to $4,475 an ounce. And copper has retraced recent gains, falling around 3%. Iron ore down to $108 US a ton. And Bitcoin is trading at around 91,000 US dollars. Well, let's get across what we're seeing on Wall Street with the outlook for 2026. We're joined by Morningstar's Chief US Market Strategist, Dave Sekera. Dave, Happy New Year. Welcome back. Great to see you. So,
good morning. Good to see you.
How are we set up then? I note you say from the outset here that we should strap ourselves in, that 2026 you think potentially could be more volatile than the previous year.
Exactly. And when I think of 2025, yes, we did have a lot of volatility at the beginning of the year. Coming into January, we had DeepSeek hit the headlines. That really hit a lot of those overextended AI stocks. And then, of course, we had President Trump's, Liberation Day tariffs, which really sent the markets reeling. But of course, pretty quickly after that, he relented. He did pause and suspend a number of the different tariffs. Volatility moderated pretty quickly thereafter. Had a little bit of bumps here and there through the rest of the year, but for the most part, it was mostly just up and to the right. So I think the good news is for investors that can take advantage of volatility, I think that 2026 is really shaping up to be a very volatile year. The bad news is going to be for those investors that don't have much of a risk appetite. So like you said, I think they're going to have to buckle in for this year. But there's just a whole host of different risks outstanding that I think we're going to have to live through over the course of the next 12 months.
Well, among them, geopolitics. We'll get to that in just a moment, given how the year has started, of course. Let's first start with what we're seeing with that AI trade. Of course, as I mentioned there, investors increasingly concerned about the valuations we're seeing there. How do you think this is likely to play out over the course of the year, Dave?
Well, and it's going to play out here pretty quickly in the next couple of weeks. So AI stocks, when you look at their valuations, they require even greater growth, to keep moving up from here. So the big focus over the course of the end of this month and going into the beginning of February is when everyone's reporting their fourth quarter earnings. They're going to be giving guidance for 2026, and in that guidance, they're going to highlight how much they're going to be spending on artificial intelligence. At this point, I think that the market is expecting that to increase. So we're going to see whether or not how much they increase is enough to satisfy the markets. If not, I think there's a potential for some downside activity here over the next, call it couple of weeks. Some of the other things I'm looking at, when I look at monetary policy in the U.S., I think the Fed might be on hold until June. I think there's a very high chance that, they're going to wait until the new chair takes over. That's not going to be until May. The next meeting then is June. So markets pricing in at least another rate cut before then. I think the market, might be disappointed. You mentioned earlier, we've got all the trade and tariff negotiations. It's actually been relatively quiet over the past, couple of weeks, past couple of months. So I'm assuming by next spring, I think a lot of that rhetoric is going to, heat back up again. The USMCA, our agreement with Mexico and Canada, is one that I know our administration is going to be taking another close look at, here in June. We're going to be back to the table with China once again. So I think that's also going to potentially bring more volatility into the markets. Unfortunately, our economist is looking for the rate of economic growth to slow the next couple of quarters here in the United States. So I think that's going to be a bit of a headwind until the second half of the year. They're also looking for hotter than expected inflation. So our inflation outlook is a little bit higher than consensus right now. So we are going to be getting some PPI, CPI numbers out next week. We'll keep a close eye on that. And then, of course, here in the U.S., we've got our impending midterm elections later this year. So that will also increase political rhetoric. But also, I'm also concerned that you might see the Trump administration try and push through as much of their agenda as they possibly can while they still control Congress. So when you wrap all of that up, certainly a lot of risks that we're going to have to live through.
Now, as you've alluded to there, certainly heading into the latest earnings reports led by the banks. What are your expectations on that front?
I think it's actually going to look pretty darn good. When I think about the banks, taking a look at kind of the real big drivers there, the steepening yield curve here in the United States, that's going to increase their net interest income margin. We're looking for additional steepening over the course of the year, as we are looking for a couple of Fed cuts in the middle and second half of the year. The economy in the U.S. has actually been doing much better than expected the past couple of quarters. A lot of that, of course, being due to the AI build-out boom, but that's going to keep default rates and bankruptcies relatively low, so their charge-off numbers, I think, are going to look pretty good as well. Investment banking activity, trading activity, both been very high over the past quarter. Expecting a lot more mergers and acquisitions over the course of this year. So I'm looking for pretty good news out of the mega banks. Having said that, when I look at the valuations, I think all of that and more is already priced in. Names like JP Morgan, we think, are pretty fully valued, if not necessarily overvalued at this point.
And in terms of those AI stocks ahead of their reports as well, obviously a focus on the vast amounts of capex that's been thrown around at the moment. What are you making, and which sort of companies have got an eye on? And I should also note there, of course, as I mentioned there earlier, Alphabet has been doing very well of late, now rising to number 2 in terms of capitalization.
Yeah, so I mean, the real action here in the U.S. is going to begin the week of January 26th. That week we've got Apple and Amazon. So everyone's just going to be focused on what they're doing, for CapEx spending, what the guidance is there. We have a divergent view on those two stocks. Apple is a 2-star rated stock. We think that stock is overvalued. Amazon, a 4-star rated stock. We see value there for investors. Another one we'll be reporting will be Netflix. That's also very highly valued. I think that one is at a lot of risk if it disappoints. That's another stock that we think is overvalued. And then also we'll see some early AI indicators with ASML, IBM. ASML, of course, is the company that makes the equipment, that makes the semiconductors. That's a stock that interestingly lagged quite a bit in 2025. And then we saw a big ramp up in the second half, actually in just the last month or two of the year. So it went from being a 4-star rated stock up to a 3-star rated stock. It's now a 2-star rated stock. So we think that one's a little overextended. So we'll need to see some good news out of that one to keep that stock price up. And then IBM, I think that's going to be a good read on AI consulting, the ability ability for a lot of these companies to monetize artificial intelligence. That's another one that we're concerned about the valuation. It's another 2-star rated stock that's overvalued. But then beginning of February, as you noted, Alphabet, parent of Google, is going to be coming out, Microsoft, Meta, AMD, ARM. So that's where the real action is going to be as far as, watching those capital expenditure numbers. Several of those we think are still undervalued, like Alphabet, Microsoft, but others like ARM we think are too highly valued today.
Now, Dave, as I mentioned there, 2026 beginning with a bang in terms of geopolitics, certainly what's transpired in Venezuela. How is this likely to play out on the oil market, do you think? And what's your view in terms of those oil and oil-related stocks?
Well, when I break it down and think about here in the short term, there's been no change to our oil price forecast, and as such, really no change to the intrinsic valuation of the oil stocks that we cover. When you think about Venezuela, I mean, it's been 20, 25 years that the Venezuelan government has been underinvesting in the oil production infrastructure, so it's going to be years before we really see any kind of meaningful amount of increase in oil production. And of course, it's a very different type of oil that comes out of Venezuela. Thinking about it in the medium term, it is going to be a very good tailwind for those undervalued oil field services stocks. A couple of stocks we've been highlighting to investors are Schlumberger, ticker SLB, Baker Hughes is the other one that we've been very constructive on. These are going to be the companies that are going to be there to help Venezuela build that production infrastructure over the next couple of years. Seen a lot of positive market sentiment on those stocks, so those have been moving up closer and closer towards our fair values. And then lastly, long term, certainly a tailwind for companies like Chevron, who's already involved in Venezuela. But I think it's also going to be beneficial for a lot of those firms that had assets in Venezuela that were nationalized when Hugo Chavez took power back in 2007. So for example, Exxon and Shell. I know Exxon has a couple of different rulings outstanding with the International Chamber of Commerce. So it'll be interesting to see what happens with those assets, whether or not there's a potential they could be returned back to Exxon, or if they're going to have to pay, some sort of fee to Exxon, to keep those assets. And then, of course, as Venezuela ramps up, I do think that over time, Canadian oil prices, could be under pressure. Canada, of course, a big exporter of oil to the U.S. So I think that we could see some production pressures there, especially in those companies that also transport oil, the midstream, from Canada to the U.S. refiners. But at this point, that's at least several years out before any impact there.
Dave, we're almost out of time. Can I get to your market positioning for the year then, particularly with your core holdings in terms of those stock picks?
Yeah, so real quickly, I mean, we are market weight equities at your targeted allocation coming into the year. U.S. stocks are trading at about a 3 to 4% discount from our long-term fair value. I think investors should think about having a barbell-shaped portfolio. I think you still need to retain the upside from potential tech and AI still running further. A lot of momentum there. Stocks like Nvidia and Broadcom we think remain undervalued. But I think you should offset that high-quality value stocks. You can be able to use those to balance against that elevated volatility in 2026. That way, if the market is running too hot to the upside, you can take profit in some of those AI stocks, reallocate the value. Conversely, if we get any kind of good sell-offs, those value stocks are going to hold up much better. You can then sell those and then be able to use those proceeds to buy the beaten down AI. A couple of quick core holdings I would highlight be Microsoft, 4-star rated stock, 20% discount, gives you that upside potential in AI. Also in tech, we like Palo Alto. It's a 4-star stock, 15% discount. I'm a big fan of investing in the cybersecurity industry overall. Utilities, kind of that second derivative play on AI. Duke Energy, 4-star rated stock at an 11% discount. And lastly, if you're looking for an oil pick here in the U.S., Devon Energy. It's a 4-star stock at a 35% discount. So I think that one's very interesting, especially with oil prices where they are today.
Dave, great to get across your 2026 outlook. Thanks for joining some Morningstar.
Oh, thank you, Andrew.
Dave Sekera, Chief US Market Strategist there at Morningstar. Let's turn our attention to where we're likely to get going on the local market, looking for a positive start. In fact, we don't have that up, but last time I checked, we're up about 0.4% on SPI futures. Stay with us. The open is just a minute or so away.